People are having to use that credit card to buy groceries. People are using that credit card to pay for childcare. People are having to use that credit card to just pay for the basic necessities that have feels like doubled in price over the last couple of years. Credit card delinquencies are surging. Americans are battling high inflation and high interest rates. And this, in my opinion, is the number one leading indicator that you need to keep your eyes on as the economy is getting worse and worse. Credit card debt is hitting all-time highs. We're over $1 trillion in credit card debt at this point. And some politicians would tell you that just means the American consumer is so happy they want to go out and spend their money, right? They don't mind racking up a little credit card debt because they know they can afford it. But we know the truth. People are having to use that credit card to buy groceries. People are use that credit card to pay for childcare. People are having to use that credit card to just pay for the basic necessities that have feels like doubled in price over the last couple of years. And the problem with trying to gaslight Americans into thinking that we are only using this selfishly because things are just so great. The problem is that we remember what everything costs. 2019. We will remember what everything cost during the Trump era. We remember all of that. And then you're trying to tell us, oh, inflation's cooling. Things are getting easier. Stop complaining. Prices are going back down. They're not. Inflation is still over zero. Let's just do a little picture time with Chris here, right? Let's say inflation is at this level here. Let's say inflation's at 2% or so. And then it spiked up to 9%, okay? And then it's going up another 3%, and then another 2%, and then another 3%, and then another 2%. At what point did prices ever come back down? I don't see that point. In fact, what I see is prices going up, but maybe not up as fast. That's what we're dealing with today. And because of that, people are their income is not keeping up with inflation. A growing number of Americans are falling behind on their credit card payments as they continue to battle high inflation and interest rates. All stages of credit delinquency are 30, 60, and 90 days past due are rising in the third quarter, surpassing pre-pandemic levels for the first time. Delinquency rates are now approaching the highest level since 2012. 2.21% of credit card balances were 60 days late during the 3-month period, up from 193. Now, when you get into granular numbers like that, just keep in mind, for every $100 that a bank is loaning out on credit cards, $2 are delinquent. 3.19% are 30 days late. And 1.52 are 90 days late. So if I'm an institution and I'm loaning it out, and I'm loaning out $100, and I can only reasonably expect to collect 97 to 98%, you know what I'm going to do? I'm going to raise the rate on everybody. I'm going to say, because of these people who are not paying back their balances, I'm just going to raise the rates across the board. I'm going to make everybody else pay more on their interest rate to make up for the fact that I'm losing 2 to 3%. Sorry, deal with it. What are you going to do? Not use your credit card? We've got you in a system where you can't stop using your credit card. Just try to stop using your credit card and see what happens. That's what these people are telling you, right? The spike in delinquencies, banks are giving fewer credit line increases and reducing credit lines more frequently. And not only in credit cards, but I've seen all these different auto lenders. They're getting right out of the auto lending business. And the auto rates are going astronomically higher because they're looking at everybody who's about to start defaulting on those loans that they took out in 2020, 21, 22, 23, where they were paying over sticker price, paying the dealer premiums, and now they can't afford it. They can't afford their $1,200 a month car payment, in addition to the groceries that have doubled, in addition to the student loans that are coming back, in addition to the credit card payments. The rise in credit card usage and debt is particularly concerning because interest rates are astronomically high right now. The average credit card rate is at a new record of 20.72%. And the previous record was 19% all the way back in 1991. And hey, if you're just tuning in, my name is Christopher Yule. We cover the biggest headlines of the day and what the AI trading data has to say about it. And if you're interested in that too, be sure to definitely hit the subscribe button down below and start trading with the world's best AI stock trading assistant. Head to ovtlyr.com to see why outliers win. Although inflation has cooled considerably in recent months, it's still up 3%. It's still up 3.7% compared to the same time a year ago. And that is the part where it drives me absolutely up a wall. I get so frustrated when I see these news commentators, and especially the left-wing outlets, coming out and saying, inflation's over, we won, that was easy, there was no damage done to the economy, and we have fixed everything. No, you haven't. My grocery bill has doubled since you've been in office here. And not only that, prices are not coming down. They may not be going up as fast, but they certainly sure as heck are not coming down. And that's why I've been saying for a long time, I think we need to see some real deflation. I think we need to see some real disinflation. Both of those are different terms, so they are real things. We've never experienced that in our lifetimes, and I hope we actually can. Now, the problem with disinflation, and deflation is that when this happens, it can spiral, right? Let's say, for example, I want to sell my home and I can't find buyers. So I drop the price. Let's just use round numbers. Let's say I have $1 million home and I need to drop it to 900,000 to just attract buyers. So I just de-inflated my house. I deflated my house. Nobody's buying because all the other market participants, everybody out there who wants to buy a house, they're looking at this saying, geez, if he just took $100,000 off, why would I wait? Why would I buy it now? I can just wait. I can sit on it. Where I, as a seller, I'm like, geez, I gotta get out of this house now. So I'm gonna drop another $200,000. So I just took a 30% deflation on my house. And you as the buyer, you're thinking, I think I'll wait a little bit longer. Let's see how much pain he can take before he really gives in. And that is the downward cycle. And that will happen to everything from homes to autos, to your groceries, and then to your job. So while I do want to see some deflation, I don't want to see it spiral out of control. The inflation spike has created severe financial pressures for most U.S. households, which are forced to pay more for everyday necessities like food and rent. The burden is disproportionately borne by low-income Americans whose already stretched paychecks are heavily affected by price fluctuations. Yeah, dude, if you couldn't afford things before, this inflation is absolutely killing you. And then everything's going up in price like rent, insurance, groceries, gas, you name it. And it's only hurting the people who can afford it the least already. So speaking of what's in your wallet, let's go take a look at Capital One, right? Taking a look at Capital One, we got a sell signal back on November 22nd. If you had been following these signal returns, you would have seen a 40.77% return, which is pretty outstanding. So if you want to get your hands on these outstanding signals, head to ovtlyr.com to get probably the greatest deal of our entire life and start trading with the world's best AI stock trading assistant. All right, let's take a look at this. So this is what the internet's saying, right? Despite the Fed's signal to pivot, interest rates on new car loans are still rising. The average rate on a 48-month new car is 8.5% for the first time since 2001. 8.5%. Jeez Louise, that's high. The same can be seen with credit card debt interest rates, which just hit a new all-time high. So why do autos, credit cards, and buy now, pay later financing all continue to charge higher rates? It's a combination of default risk and providers for those financing options knowing consumers are desperate. Debt is fueling consumer spending. Yeah, so this is the interest rate. Now, it has, of course, gone down over many, many years, but it's spiking back up. We're looking, the last time it's been this high was 2001-ish, and then it got as high as, 17% back in the 80s, which I definitely don't want to see that. But that's what I'm talking about here, right? If delinquencies are rising, the only way for these banks, institutions to make up for it, they're going to jack up their rates even higher. which is going to cost more people to max out those credit cards, and then more delinquencies are going to happen. This is not looking good at all. This can go on a lot longer than everyone thinks, which, oof, yikes. Consumers that are no longer being employed, getting wage increases, or reducing their spending are becoming overextended. They'll take on debt to continue living a lifestyle they got used to living in the good times that they can't afford anymore. Absolutely. The debt cycle will lead to a collapse. At some point, they can't continue to get credit extended to them, and they're going to default on something. Yeah, absolutely. There's so much going on in the economy out there that it's frustrating when the politicians want to tell you that everything is great. We know it's not great. We're living this every single day. And I don't know of really very many people at all who are saying that their life is better in 2024 than it was just a few years ago. Because we can all remember a time where we were more prosperous. But I also know that the YouTube algorithm is incredibly smart, and it thinks that you're going to love one of these two videos. So click one of these to watch more, and I'll see you on the next episode.